Hello. Good morning, everyone. Thank you so much for joining us. We have a very exciting panel on RWAs, or real-world assets. I'm Tracy Wong. I'm an investor and head of special projects at Framework Ventures. A little bit more about Framework. We're a crypto-native venture capital fund based out of San Francisco, founded in 2019. And currently, we are managing over $1 billion in assets across 4 different venture funds. And before I joined Framework, I was also a journalist and editor at Coindesk. So Consensus is a conference very near and dear to my heart. I want to turn it over now to our esteemed panelists. Maybe if you can tell the audience a little bit about yourself and kind of your company. And let's start with Nathan and go down the line.
Great. Yeah, thank you so much for having me here. I'm Nathan Allman. I'm the founder and CEO of Ondo Finance. My own background is in traditional finance. I worked in private credit, and then I was at Goldman Sachs on the digital assets team, helping to shape their early crypto blockchain strategy from 2019 to 2021 before founding Ondo. Ondo is in the business of bringing financial markets on-chain to make products and services more accessible. We tokenize real-world assets, starting with US Treasuries, next getting into stocks, bonds, and ETFs. And then we also build infrastructure and protocols to make tokenized real-world assets more useful, to leverage the benefits of DeFi and apply them to regulated securities.
Carlos?
Yes, I'm Carlos Domingo. I'm the founder and CEO of Securitize. I think we've been doing tokenization of real-world assets before the term real-world assets existed. I started the company in 2018, so we've been around for a few years since the first wave of tokenization, and now the second one happening. We are a regulated platform. We own registered transfer agent, broker-dealer, ATS, and investment advisory, and fund admin services, and we basically serve asset managers as opposed to issue our own assets. We're the largest platform in the industry. We manage over $4 billion now, and have the largest asset, which is Beetle, is a tokenized treasury fund that we do in partnership with BlackRock.
Hey everybody, I'm Jim Hiltner. I'm a co-founder and head of business development at Superstate. Prior to launching Superstate, I was at Compound with Robert Leshner and my 2 other co-founders, and we looked at the landscape and identified that DeFi, had a really low ceiling in terms of the opportunities that could trade on chain, and decided to, bring more assets into this ecosystem. So my background is traditional finance and fintech, and yeah, we've got a lot cooking on our end as well.
Thank you. I guess to kick things off, let's maybe talk a little bit more about what an RWA is, and why are we even bothering to tokenize them? Let's start with you, Nathan. Maybe.
Sure. I mean, what is tokenization? What are real-world assets? It's just the representation, of something off the blockchain on the blockchain. It's a way to take advantage of the technology of crypto. Bitcoin being the first digitally native scarce asset that can be transferred peer-to-peer globally 24/7, used in smart contracts, and apply those to assets that are not digitally native like Bitcoin. Stablecoins, of course, are the largest real-world asset. There's more than $200 billion worth of stablecoins today, that track the price of a dollar and, leverage a lot of those same benefits of, Bitcoin and other assets. In terms of why, there's a lot of potential benefits, and there's been a lot of experimentation, dating back to Carlos's early days in the, 2018 real-world asset wave. I think historically a lot of the focus has been on driving efficiency gains, cost savings, bringing more liquidity to historically illiquid assets. I think there's certainly some, potential validity to a lot of those benefits, but of all the potential benefits out there, the one that we're focused on at Ondo most is accessibility. So primarily making US-based, very liquid financial assets, like US Treasuries, soon like stocks, bonds, and ETFs, and making them very easy for investors all around the world to, buy, sell, hold, and use in DeFi.
Mm-hmm.
I think RWAs is a terrible name to start with, because in finance it's called risk-weighted assets. In crypto it's a a term that emerged, like 2 or 3 years ago, which I think has a positive aspect, which is signifying that you're trying to put on chain real stuff as opposed to, let's say, imaginary internet money and things that don't have an intrinsic value. So anything that has intrinsic value in the real world, you're going to use a better ledger to manage it. And then I think there's broadly 3 categories: tokenized commodities, which none of us deal here with it, but they're like out there, like tokenized gold and things like that. There's stable coins, which are tokenized dollars, which is arguably, or not arguably, it's actually the most successful, tokenized asset out there, the one that has product market fit, huge size, etc. And then tokenized securities, which could mean, anything that is a security. It's a securitized asset that you basically securitize to turn it into a security to be able to provide fractional ownership. Could be existing securities like funds, private funds, registered funds, stocks, bonds, ETFs, and everything that Nathan mentioned. That's the part of the market, tokenized securities, where we focus most. That's the one that has the biggest potential because it's a huge market in TradFi that is extremely inefficiently managed, and it's extremely inefficiently managed by one particular problem, which is the ledger where you represent the security is usually a very inefficient one. And on top of that, the ledger where you represent the counterparty asset that you trade with, whether it's dollar or some other currency, is a different one that they're not properly connected. So I think that tokenization is essentially using this better ledger technology, which are public blockchains where you can represent alongside securities and dollars, and you can then move them around in a much more efficient way, enable new use cases, and basically more functionality for the asset itself, as opposed to just pure efficiency, which, as Nathan mentioned, that was kind of like the focus at the beginning. I think that's less interesting in my opinion, and one of the reasons why the asset class hasn't taken off. I think today we're seeing this resurgence of the asset class because of the utility that you can provide to the tokenized assets, as opposed to the same asset in traditional finance.
Yeah, I mean, I look at tokenization as supercharging traditional assets. And when you tokenize something that is available in, quote unquote, the real world, you upgrade its functionality. You provide more access. It is faster. It's more mobile. It's self-controlled. And I think it just generally takes the legacy infrastructure that we have in financial markets and brings it into the new age. The whole thesis behind Superstate and why we launched 2 years ago was, again, DeFi, I think we all agree in this room, is really fantastic technology. And as I was watching Terra Luna and all these centralized lending desks blow up, we looked across the table to each other and realized that the addressable market for the technology of DeFi, which, by the way, was extremely resilient and efficient at managing risk, was limited by the assets that were compatible with those systems. And so, what Ondo, Securitize, and Superstate are all doing is trying to take the infrastructure that exists in the traditional capital markets and bring that on chain so that they can interact with these amazing systems and do it in a highly compliant fashion as well. There's like 4 different things that I look at in terms of the trends of like why this is all happening right now. And I think one of them is, I mentioned it, DeFi and blockchains are getting to tremendous scale, and you can see extreme volumes and scalability that is demonstrating the ability to take on a lot more activity than currently is accessible on those rails. 2 is that institutions and regulators are really engaging. Both all 3 of our firms here, we both are innovators ourselves, but we also work with incumbents of the financial ecosystem in order to be able to demonstrate really powerful use cases in terms of collateral management, issuing new securities, and generally many different applications. And that engagement, I think, is extremely powerful. Plus, the regulatory front is a lot more open, and I know we'll probably touch upon that here in a minute. The third thing is that the applications that exist in this ecosystem are getting better and better every day. I think when all of us started to do stuff on chain, it was quite clunky, and you had a lot of friction in terms of like what the consumer experience looked like in order to interact with like an Aave, a Compound, a Curve, or whatever it might be. And there was a lot of there was a high steep learning curve. But I think these interfaces are getting a lot stronger, both for retail and institutions, to make it much more native to what they're used to on a day-to-day basis. And the fourth thing I think is just like a general trend in investors wanting control. of their assets. And if you look at the existing financial system, there's a lot of gatekeepers. And the access that Nathan alluded to earlier for certain types of assets is quite challenging. And so by bringing these assets on chain and structuring them in a way that allows people to invest in certain types of securities or funds or real estate or whatever it might be that right now is difficult for them to get into in the existing system will allow folks that are looking to self-direct their own financial future to do that in a way that's not compatible with the existing system. So I think that those things are all making this a trend. That's why RWAs is getting a lot of traction right now.
I think it's important to bring the historical perspective. In 2017, 2018, when me and there was like 40 companies at that time, like now there's another 40 companies doing kind of like the same. So crypto, when I started, I think it was around like $100 billion asset class. That's the entire crypto, including Bitcoin. Stable coins was only Tether, the only one that existed, and it was like $2 or $3 billion size. And I think USDC launched later, and it was very, very tiny for a long time. And now there is like $250 billion of stable coins, $3 trillion plus of crypto assets, and the stable coins are like 40 different out there. And then DeFi didn't exist. So DeFi summer was 2021?
2020.
2020. So there were like some DeFi protocols, like the early ones, like Aave, you guys, Compound, etc., that existed, but they didn't, take off until 2020, 2021. So the value add you could provide of these assets by like doing a better lending, the infrastructure itself didn't exist in the crypto ecosystem. So there was really not much you could do with the assets, and if you try to bring it to the TradFi people, tokenize assets, it adds a lot of friction. You need to deal with wallets, you need to deal with what blockchain are you using, who's in the custody. If using alongside stable coins is the advantage, then are stable coins regulated or not, etc. So that doesn't really work. So I think that the shift towards bringing real assets into crypto, now that crypto is very, very large, stable coins are huge and have market adoption, and DeFi exists at the scale as a proven technology that you can use in a different context, because obviously these are different assets than permissionless assets. I think that's what's making the industry really taking off now.
Nathan, do you have anything more to add on why now? It seems like RWAs have been around for many years in crypto, preceding DeFi, preceding meme coins, and seems to be really gaining momentum now.
Yeah, I mean, it's hard to ignore with Superstate here on the stage, much of the Superstate team being born out of Compound. I totally agree with, what Carlos is saying about, DeFi was not around in the early days of tokenization, and, it really came to be in 2020, 2021. I think Compound, decentralized lending, the, collapsing of the supplying of capital and the borrowing of capital over collateralized against, crypto or potentially securities in a peer-to-peer, autonomous, transparent, always-on manner with no intermediaries. I think that's very, very powerful and something that got me really excited about the promise of DeFi and wanting to reapply it to traditional securities. And I look at some of the very early Compound press releases. There was talk at the time about wanting to reapply it to securities. And so, actually, when we first launched our first tokenized treasuries product in, I guess 2.5 years ago now, the start of 2023, that's OUSG, it was a week later that Flux Finance, a DeFi protocol we developed that was a fork of Compound, that was launched, which let investors lend and borrow stablecoins over collateralized by tokenized treasuries, and demonstrated some of the potential utility of merging DeFi with traditional assets. While that has all been happening, on the institutional side, there's been a lot of experimentation around the use of permission blockchain ledgers, even for repo, right? I mean, JP Morgan's intraday repo facilities, probably the most cited example of like driving real savings and cost efficiencies to institutions from the use of permission blockchains. Now we're very focused on accessibility, now that there's, as Carlos cites, all this crypto wealth and this big industry globally of folks that want to be able to tap into these assets, and the two worlds are starting to merge. Just this morning, we announced our partnership with JP Morgan to connect their permission blockchain with on-chain and to enable for the first time 24/7 composability between bank deposits that are tokenized on their ledger and tokenized treasuries that are on chain. So yeah, really
Congrats.
excited for those two worlds to come together more.
Amazing. Well, I was just going to ask if anybody had any special announcements or, what's top of mind, any new announcements or product launches to share with the audience. How about we start with Carlos? I think everybody on stage has been very busy the past few months. And so now is the time to brag about what's going on at Securitize.
I think that the last couple of things we've announced that are kind of relevant. One is yesterday we launched with Van Eck, a different version of a tokenized treasury product, which is very exciting because it taps into a different ecosystem. It's the first one that we've actually integrated with Binance Chain. It's integrated natively with Agora, which is another stable coin that we were not using before, etc. And it has like different characteristics and Beetle that I think serve a different part of the market. So that's very exciting to get another like high quality and also very crypto-friendly asset manager like Van Eck. Jan Van Eck has been in the industry for a very long time, into the industry. And touching what Jim and Nathan were talking about lending, we announced 2 or 2 weeks ago, I don't remember exactly when, basically a partnership between us, Gauntlet, and Morpho to be able to provide recursive lending for RWAs, starting with the Apollo credit fund that we have. So Apollo launched a credit fund at the beginning of this year. It has become the largest tokenized credit fund in the industry in very short period of time. And then the Apollo credit fund today is yielding like around 9.5%, right? And then crypto lending rates for USDC today are much lower. They're sub 4%. So this is in a scenario where you can just pledge this as a collateral in a DeFi protocol. In this case, we're doing it with Morpho, and then borrow USDC. Then you purchase the asset again. You borrow more USDC, you repurchase, and then you basically increase the amount of exposure you have to the credit fund. So you amplify the yield by leveraging, doing this recursive lending. And this is all done with Morpho, which is basically a crypto lending protocol, very similar to how Compound or Aave or others operate, and Gauntlet curating this vault to create this loop. Now, so you take an asset, just to summarize, that yields 9.5%, and by leveraging the asset, you can make it somewhere between 15 to 20%, depending on the loan-to ratio that you pick there and the risk that you get liquidated. Okay. So if you think about how this will work in traditional finance, let's say he was talking about JP Morgan. I'm a JP Morgan wealth management customer. It's a very simple process. If I want to subscribe to an Apollo fund in JP Morgan, it's going to take me, in the best case scenario, 2 weeks. I have sent an email, then somebody will call me, they'll walk me through the product. There's nothing I can do by myself on their portal because the portal doesn't have any direct interaction with users. It's just like a view-only thing. Eventually, they'll tell me, just subscribe this. Then I'll have to wire them money. The money gets there. Then they will have like a subscription window, which maybe I miss or not. And at some point, I'm subscribed to an Apollo fund, and I own the Apollo fund. Now I want to borrow against the Apollo fund. This is like almost like mission impossible. So JP Morgan maybe doesn't give you a loan against the Apollo fund. So you have to go to somebody, and you go to Morgan Stanley and tell me, can I borrow against this Apollo fund? And the first question is like, how do I know you own it? Because you purchased it from JP Morgan. There is no proof of record that you actually own it except at the JP Morgan database, which is completely centralized and isolated. So you have to go through hoops to be able to like borrow against this asset. And eventually you do it, and you get the money, it gets wired to you, another few weeks have passed. Now if I want to resubscribe again with the asset to leverage it, there's another 3 weeks dealing with the JP Morgan people to get it done. So it's like literally impossible. And in case you could do it and take weeks, there is no way to manage all these loans that I've incurred. What happens if the lending rates change and they need to liquidate me? They just don't have an automated way for me to unwind my positions and go back to my original asset without taking any risk in between. So I think crypto and the DeFi lending protocols, when they're adapted to this, tokenized securities, they're an extremely powerful way of providing, new products like this structured product based on an existing high-quality credit product that is literally impossible to do in traditional finance. And to me, this is the most exciting thing that's happening in the industry now, that we're not just using a better ledger, we're actually making the asset better by being able to do something with the asset that it was impossible to do before, and making it a better product for the investors in the asset. So.
Thank you, Carlos. Jim, what's going on at Superstate?
Yeah, I don't want to spend the rest of our time just shilling, so I'll be quick. We just announced something that we think is going to be a game changer for not just crypto, but for public markets writ large. It's called opening bell. I think it's that thought in your mind, if you're a founder out there, of ringing the opening bell and going public is the ultimate goal for pretty much every company that forms. And it's really, really difficult to do so. It's really expensive. There's a lot of intermediaries, and you have to wait until you're of a certain size that by the time you do go public, ultimately investors, retail, and broad investors are able to participate in the growth of your company, but you've already probably hit Series Z at that stage. And so what we're excited about with Opening Bell is helping companies go public that are in the private markets now and give people the access to a publicly registered security through the capital formation that's possible on-chain. And that is the actual equity in the company, whether it's a crypto native organization or not, helping them start their public market journey sooner by tokenizing the actual shares in the company. As well as on the other end of the spectrum, helping companies dual register their shares, because there's a lot of activity that happens on chain. I mean, I was looking at some stats last night, and I think Coinbase got added to the S&P 500 last night, and yesterday 24-hour trading volume was like $7 or $8 billion. That's a lot. I mean, Melania meme coin when it launched was the same amount. Trump was like 4 or 5 times that. So there's a lot of activity that's happening on chain, but the problem is that the assets that are largely available in most of these ecosystems aren't rooted in fundamental value. And so our goal is to help take companies public, and Opening Bell is going to really change the equity capital market structure. And companies are no longer, in our view, needing to stay private until they're worth $500 or $600 billion and be traded just in secondaries and SPVs, but actually democratize access to that at an earlier stage, so that folks that identify opportunities in companies, which I think is why they like crypto. They love crypto because they can find a protocol like Ondo, and they can invest in the token before it hits the scale that it's hit right now. You can't really do that with public equities. And so that's our goal, is to help, through Opening Bell, give folks that opportunity to participate in the highest growth, most exciting part of a company's journey.
Exciting. I want to talk about regulatory stuff for maybe 3 or 4 minutes, and then probably we have time for one closing question. But we have a now crypto-friendly administration, crypto-friendly SEC and CFTC. I'm curious if that has impacted the way you guys are engaging with regulators, and what you see as the kind of big regulatory hurdles going forward over the next maybe 2 or 3 years, and how you're dealing with that. Maybe let's start with you, Nathan, and go down the line.
Sure, yeah. I mean, in terms of how things have changed, we went from substantively no engagement to being a big focus. And
co-hosting the crypto ball and some other headlines I saw.
Yeah, so certainly engaging with primarily the SEC and Treasury, and there's a lot of cross-regulatory issues that need to be coordinated, and it seems like this admin is really focusing on that, so that's fantastic. In terms of the actual hurdles, I mean, there isn't yet really a blueprint that issuers can follow for how to issue public tokenized securities, particularly Reg NMS securities that trade on stock exchanges in the US, especially in a way where the tokens can actually have utility, ideally meaning they're bearer tokens, they can be used by smart contracts and so on. We think that it's possible to make public registrations of that sort, but it's not something that the prior administration likely would have approved. We've seen a lot of attempts to add utility to tokenized public securities, particularly from the likes of Franklin Templeton and other large asset managers that at least in the prior admin had pretty incremental progress. So I think that's step one, like getting some actual public filings done that bring these assets to market in the US in a way where the tokens have utility. And then the next step, which I think is probably a little bit more challenging, is getting either exemptive relief or rulemaking or guidance on how the secondary market apparatus, so like wallets that might want to distribute these tokens, DeFi protocols that might want to build on top of them, how they can operate without running afoul, particularly of securities laws. There's still this looming question of how and whether a DeFi protocol has to register, for instance.
I just want to say something. So we've interacted with the Clayton SEC, with the Gensler SEC, and now with the Atkins SEC, which Atkins in particular was an advisor in our company since 2019, so we happen to know him quite well. And I think that for tokenized securities, it hasn't been as problematic as it has been for the rest of the crypto economy, where there is a lot more gray area about what we do. Tokenized securities fall under the SEC, and then none of the three SECs have argue against that. Tokenized securities are securities. In other words, like the fact that you're tokenizing the security doesn't make it any different than the intrinsic security. So if you have a public stock and you issue a token that represents the public stock, if you issue it in the legal way, that token is just basically the same as the public stock. And I disagree with Nathan that you can't do that. We actually do that today. We're a publicly traded company called Exodus. We just started doing sort of like a mini IPO, like what the Superstate people are trying to do. They did a Reggae Plus. They raised $75 million in a not registered exempt offering, and then they listed on the New York stock market. And as a transfer agent, we can manage securities in both ledgers, the DTC ledger or public blockchain. So for tokenization itself, there is not a ton of things that we need the regulators to do. What we need to let them is basically admit that the fact that we use a different technology doesn't mean that we need to be regulated differently, which I think was what the previous administration did. So I don't need to have a separate custody license to the custody of tokenized securities. My broker-dealer is allowed to custody securities. The fact that they're tokenized or not should not treat me any different. So that's the thing. Now, within that scenario, if we're treated like securities and we fall under the same security regulations, then the part I agree with Nathan is that there are certain securities, or Superstate has actually filed a letter to the SEC, similar with what we requested, saying that some of the rules that regulate securities today, because they're rules designed for centralized markets with a central securities depository, do not actually work well when you're trading those securities in a blockchain in a completely different market that is not necessarily connected there, that doesn't necessarily settle at the same speed, that they don't use the same ledger technology, the same record of ledger for who holds the security. So there's nuances of things that need to change, but if anybody wants to tokenize today, there is no regulatory issue to do it whatsoever. Whoever tells you that it's a regulatory issue, it just doesn't understand how things work, because you're just using a different ledger technology. And us as a regulated entity, there's no rule that tells us whether we can use a blockchain or not. So
cool.
Maybe I could just clarify the point of disagreement.
Sure. 10 seconds.
10 seconds. Oh my God.
So
I certainly agree that securities laws are tech agnostic, and that it is possible, and we have done it in multiple instances, to issue securities in tokenized form in the US. But what has yet to be done is to do that for public securities in a way that I would argue the tokens have utility, meaning they're usable by smart contracts, and ideally, they're fundamentally in bare form. So there's certainly a lot of examples, but none that, in my opinion, have cracked that code yet, which we and others are working on.
Got it. Okay.
I'll just say one thing on this, is that go to the SEC website. There's a lot of publicly available information, written input. There are monthly, if not more frequent, roundtables where the SEC has invited incumbents and innovators to sit next to each other and talk about all of these issues. And Paul Atkins, head of this most recent roundtable, said that we're at a point where it's like when music went from cassettes to Spotify, and that's where we're at with tokenization. And I agree, it's all underlying the same regulatory structure, but the technology is what's going to take this to the future.
Mm-hmm. All right, so the closing question, and this is a one-sentence answer because we are out of time, is I would be curious to hear you guys maybe mention one, whether it be an asset or maybe an on-chain IPO, something that you would like to see in the next 5 years in the RWAs.
Next 5 years, oh my God.
I'd like us to stop we're going to stop talking about it being tokenization, and it's just going to be embedded in the fabric of the daily financial lives, and it's going to be powered by blockchain underneath the hood. But you see folks like Robinhood and others that are building the interface on top of all of these securities, and underneath it, the technology is going to be extracted away. And I think we're going to be talking about much cooler things in 5 years than like how to actually get to that point, because it's all going to be in everybody's daily trading apps.
Hitting $1 trillion.
1 trillion.
1 trillion?
Yeah.
All right.
I mean, in 5 years, I think we'll see more
Simple
investors globally holding particularly US stocks, bonds, ETFs on public blockchain ledgers than not. I mean, I agree, it will be abstracted away, and that's happening very quickly.
All right. On that note, let's give our panelists a great big round of applause.